All right, so we didn't finish the week on a very positive note and ended up relatively down, especially in these tech names. So what does that mean? Does that lead us into this widely anticipated pullback after we've been bullish for so long? How big would that pullback look like? What are the signs that we are getting that pullback? So I'm gonna break that down. I'm gonna break down the signs that we might already be in it. I'm gonna break down a signal that might suggest that we get a divergent high point first. That's a possibility. So we'll keep that on tab, especially with such a big earnings week here next week. I'm also gonna break down the concept of how bearish we would be depending on how big the pullback is and whether or not that just negates all this long-term bullishness that we have because the underlying trends that are driving this risk appetite right now. So we're going to talk about that as well. I'm going to show you a trade idea for a stock that will give us some negative deltas, that will give us a bearish trade without being too aggressively bearish. I'll show you how to do that. So let's go ahead and get started. Today is Friday, July the 24th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we had a 2 days in a row losing streak, which we haven't had in a while, right? Since we basically started this rally, and even before then, you can see it all the way back to, coming off that June 8th high was the last time we had a 3-day in a row decline that brought us from what was then the 0% line to the 23% line. We've since moved the 0% line up higher. We're 2 days into this one. We'll see if the third day is into the next one. And you can see, like, between the 0 and 23% line, look how high the intermediate line is. Like back here, when we were at this point here, the intermediate line was just barely sitting at the 23%. By the time we got the pullback and we actually got below the 30-day moving average and retested that 23% retracement level, we get light pink shading and yellow line. Very good bullish pattern, right? But in this particular case, you can see that if we were to break through and touch the 23% line again, which again, from 0 to 23 is just noise. That's not a pullback. That's just pure noise. By the time we did that, that would actually be a 3.5% drop below the 30-day moving average. So more than likely, the next time we test the 23% line, that will be an intermediate pullback. And in class, I kind of brought up this scenario back here where we did come up very similar, coming off the strong low point, big rally. We actually finished with a cluster. We didn't quite get a cluster over here, but we came pretty close to one. I think we did get one. No, we didn't quite get one on the NASDAQ. And we didn't get one on either of these. The S&P was the closest to getting one, right back over here. We had all four lines up above 75 at the time. But we got a cluster here, and then, again, very similar. We ended up dropping through the 30-day moving average all the way down to the 23% level, and that was about a 4% drop from high to low, or excuse me, below the 30-day moving average, By the time we hit there, we got dark pink shading and a red line. We tried to bounce off of it and get going again, but the damage was done, right? We had an intermediate pullback at that point, and we actually eventually went a little bit more. So, over here, we didn't quite get that. We went straight down initially and then just stayed down. So you can see the different alternatives, but the point is, versus, say, this line, this drop here, and this drop here, where we got light pink shading in the yellow line because we dropped below, we just barely dipped below, like 1.5% or less. Over here, these were big drops. This was like 4%. This was, I believe this was 3.5%, and this was 4%. And again, a drop to the 23% line again would be a 3.5% drop below the 30-day moving average right now. Again, if it takes another day or two, that moving average is actually rising. So it would actually be more. It would be closer to 4%. And again, that would just be the 23% line, much less dropping eventually below to the 38, which is what happened back in that scenario here, where we dropped initially to the 23% and held, but we had turned, we had this bearish intermediate pullback. The intermediate line had dropped, and then we fell below. Keep in mind that the intermediate line back here, the intermediate line on this case had fallen. The market sentiment line was much higher. The intermediate line had fallen down below by the time we had crossed below the moving average. Had fallen below its market sentiment. We're still above the moving average. The intermediate line is still above the market sentiment. It still would need to cross below. Now, one sign that it could, and most likely will, is the fact that the NASDAQ, its intermediate line is, showing light pink shading again. Its intermediate line has fallen below the market sentiment line, and still did it over here, actually, coming off of the cluster, and it's still below, and forming this bearish near-term high point here, kind of a little bit of a divergent high point when you're on the closes, and then now potentially going even lower. So we'll kind of keep our eyes on this. When you look at the NASDAQ on a weekly chart, you can see that this is a pretty decently bullish signal here. An overbought, an oversold momentum line, and a near-term line dropping below 50. I mean, you would expect, if this were a daily chart, that you would get a new near-term run out of this. Which in this case, on a weekly chart, would be good 5, 6, 7, 8 weeks. I don't think we're going to get another 8 week near-term run on the weekly chart, because that would mean that we're going to be on an intermediate run for 5, 6 months on the S&P, which would be tremendous and would make any pullback from that very uncomfortable. So more than likely, and especially considering how bullish we are, I brought this up as well. How far away from that 30-week moving average, which is 150-day, how far away from that 30-week simple moving average that we are right now. We are still very high. In fact, if you go back all the way to the 90s, if I go back 20 years, the level that we're at right now is still higher than just about any level from before the 90s at 12.92. So even though we're down, and really this peak that culminated with that cluster on the weekly chart, and then we had the weakness. Even that week, as bullish as that was at 14%. We're almost there. We're at 13%. So we're very, very high off of that level. So if we do get a bounce next week off of this pattern, expect it to maybe last for a week or two, and that's it. We might get another run, like for example on the S&P, we might get a run up to that 3390 level. But there's a very good chance and a higher probability that we might be in the midst of an intermediate pullback right now. So leave the door open for a rally up to the upside, and that's why I still have a lot of bullish deltas in my portfolio, but I don't have as many bullish deltas as I did back, say, over here, or even over here at July expiration. I have a lot more bullish deltas at July expiration, but I don't have as many now because there's this idea that we might be in the midst of that pullback, and the highly anticipated intermediate pullback that we haven't had. And again, all we really got to do is get to the 23% level first, and that will be most likely will produce light pink or dark pink shading in a red line at that point, because of how slow we've been really going here since that July 8th peak. We're actually down now since that July 8th peak, and that's well over a month and a half, 6-7 weeks of time to be really flat. So we've really slowed down, and it's made the possibility of that intermediate pullback a lot higher probability now. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel, mouse over our logo right here on the bottom right corner of your screen, or hit that subscribe button, There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Also, click the thumbs up icon that's down there too. That tells us two things: that you like our video and that you want us to do another one on Monday. It's a quick way to give us feedback. If you like our videos, you want us to keep doing them, and you want to let us know, click that right now. If you don't have to click on anything. Also, while you're down there, comment. What did you get out of our videos today? What questions or comments do you have? Post those in the comment section below. Follow or join our website at marketscholars.com if you haven't already. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow us on Twitter for more content in between the videos from day to day, and join our Market Outlook Facebook group that we've created. Another way you can subscribe to our site anywhere on our page. If you're on our site anywhere, at the top there's a blue button here. Click to subscribe. That also takes you to that same page where you can subscribe to our site. If you're watching our video here on our blog, if you clicked on the link and came here, check out these other things that we have around the video. a Market Outlook Live. Every day I do the Market Outlook. I also do a live video at 3:30 Eastern Time. I review old Market Outlook trades, see how they're doing, close any that we need to. And then we also put on today's trade idea before the market closes in that video, so you kind of get a little heads up before everybody else. Also, here's all of our classes. Our monthly subscribers get access to, that's our plus, they get access to all of our trading rooms and the Market Outlook Live video. Our premium subscribers get access to all those things, as well as our Q&A sessions. You can see mine's coming up, and all of our premium tools and access to our community and class forums where we put all of our custom content that we create for our classes. Click on this, come down here, click on this heart right there. That opens up this new window. Hit that like button. Also, hit this thumbs up icon. That takes you to your Facebook page, Facebook account. Click the like button there, right there. The more you do that, it benefits us because those platforms will promote our content to all of our followers that have a lot of likes and engagements. It also benefits you because Twitter and Facebook promotes content in your timelines from the accounts that you engage with. So we try to really make it easy for you to engage with us here. All right, let's get back to the charts. Let's take a look at the weekly chart on the crossover here. And you can see very, very bullish candle. Didn't quite close above last week's high because of the weakness. But it does show like just how bullish we are. Like any weakness we get will not be like the end of the world here. We're not going to be looking for like we're going to be falling off a cliff anytime soon. We have a strong bullish posture. It's well established. The Dow is just now giving you the golden cluster. Let's come back to this one. The Russell is closer, and it's got a very good bullish pattern. Look at the NASDAQ, however. The NASDAQ, this is what its regular weekly chart looks like. You can see, you got a little dark cloud cover candlestick pattern. You got a long upper shadow this week. Those are bearish patterns from a candlestick standpoint. Then when you look at the Hakinyashi, that's a reversal pattern. It's a Hakinyashi reversal pattern. So now not all of them turn around. You can see this one. You got one right there, and we went up for a few more weeks before we finally turned around. So not all of them lead to quick reversals, and we had a little bit of one right here as well, and that one didn't lead to one. But that's a pretty wide range on the Hakinyashi basis and a very small body. Very good chance, and we're going to open up probably around 10,005. I don't know, 5. And let's see. Let's get out the calculator, and we can tell. It's the midpoint from today's open, this week's Hakinyashi open, and this week's Hakinyashi close, which is not the open and the close for the regular candle. There's different calculations involved. So next week's Hakinyashi open will be 10,580. We are trading right now at 10,480. So we're going to have a bear. We're going to start, depending upon how we gap, if we gap to the upside, we're going to start off with a bearish candle next week. So that's another reason why I think there's a good chance that we get bearish here for a few weeks. Again, this is something simple as this. It doesn't have to be big. That's the pattern I was showing you before, where we came off of those highs on the S&P and you broke to the 23%, then to the 30. That's what that looks like. I don't think we'll get all the way to the 200, depending upon how fast this takes. If it takes a few weeks, we might, because look, the 200-day moving average will get to the 38% very quickly. And if that's the case, we're going to have a really good buying opportunity at that point. And no one's going to want to buy because everyone's going to be flipping out and losing their minds. But we'll have a really good buying opportunity at that particular point. Let's take a look at the 3 green arrow charts here, and we'll take a look at this one. So you can see the S&P finally got a red arrow. So the first one we've had in a while. So we don't quite have the every candle. Again, part of that let's go to SPY here. Part of the reason for that is you can see the MACD is crossed below its moving average. It's still pretty positive though, and we're still above the 17-day moving average. But the Qs, which is a little different. Let me get rid of this for a second. Now that we know we've broken through those, the Qs have broken. This is also their first time breaking below, but obviously a little bit different in terms of how bearish that looks relative, say, to SPY, which doesn't look nearly as bearish, but the principle is the same. Like we've been here before, so that's why a couple of times on this bullish run, right here and then right here, and we just bounced right off of this and had new legs higher. So don't count out the fact that we don't bounce up off of this again. But if we do, don't expect it to be like these, right? Don't expect another month or two of bullishness. Maybe another week or two of a divergent high point, most likely, before we finally get the weakness that we're all expecting here. You take a look at some of these other indicators. You can see the RSI has dropped back below 60. On the NASDAQ, it's close to dropping. In fact, on the NASDAQ 100, it's only to 51, so it's not breaking in the lower half chart yet, but it is the lowest level that it's had since this rally, right? Since we bounced up here and got above 50, since that rally up, all the other dips didn't get as low as this one. This is the lowest. And you also see the CCI down at the bottom. It's the first time since this rally started that we've broken below negative 100. So now you notice we can break through negative 100 and bounce back up. But a little different here because of how bullish we are and how long we've been bullish versus, say, over here where we weren't nearly as bullish and we hadn't been bullish for as long. We could make another leg higher. I don't think that's necessarily the case right now. I think, again, another sign that this intermediate pullback is in the beginning stages. Now, that doesn't mean we're going to go down every single day until we hit our low point and then we'll bounce, right? There's going to be ups and downs. Even during a pullback, there's going to be ups and downs. There's going to be times where it doesn't look like we're going to have this intermediate pullback. Like I said, if we bounce up to a divergent high point, that's still part of the pullback, right? Divergent highs are still part of the pullback. It's just not going to be, maybe it might not be as pretty. And that's the problem with a lot of people. We think when the markets are bullish, they go up every day. When the markets are bearish, they go down every day until they stop. And that's not the case. We'll go down. We'll look like we won't be going down anymore, but we'll still be in the process. And we just kind of have to watch how that process unfolds and be ready for when we do hit support and bounce to be able to take advantage of that and not be losing our heads because of how bearish it is. And we're only going to be that bearish if we get down to these levels because of how bullish we were. It won't be, that we're going to be headed towards a recession now. It's going to be it's a big exhale because you took a really big inhale to the point where you almost got sick with that big of an inhale. All right, now let's take a look at the intraday chart for the S&P 500. And we have broken below not just a 23% line of this near-term run that we've been on, but we've also broken below into the retracement zone. So below the 38% line. And you can see how easy it's going to be for us to get through the 38 down to the 78%. Now, the Qs have broken below their 70. I just deleted those on the other chart. But they have broken below their 78% chart, which means there's a good chance now that we get, instead of higher near-term highs and higher near-term lows, there's a good chance that now we're going to start getting lower near-term highs and lower near-term lows. Again, that's the definition of an intermediate pullback, or at least a bearish intermediate run, whether it's an impulse move or a pullback move. It's a definition of an intermediate run, a bearish run. So most likely you can see how that can help form on the S&P, but it won't be easy, right? We can get down to the 78% line. There's a big volume node here, but once you get through there, very easy. There's no volume below that. So you get through this level, 313-ish, get through that node, get through these lows, you break down, we're breaking down, right? We're going to be headed towards 23% retracement, which is right here, if not further below that. If we bounce on Monday, watch for that layer, that 23% line. If we can't get back above that and push through, then watch for us to hit that resistance. And if that ends up being our high of the week, if we hold, there's a good chance that ends up being our high of the week before we roll back down. So just kind of keep your eyes on that 323.5 level at the 23% retracement. Again, if we were to have any kind of bullishness at the open on Monday, we push through there and we might have a good week and we might get that divergent high point. If we hold there, that probably will be the high of the week. And we'll get that weakness further for the rest of the week as we go through a lot of really big earnings announcements. All right, let's take a look now at today's volume and trading range, which you can see very small, but you have to keep in mind we closed at 322.96. The high here was at 321.99, so we had a dollar range that we didn't fill in. So add a dollar to that. Still below the average. Still below the average on the volume, only 73 million shares. So you put that here into context, and we're still falling, and we're still relatively low. So again, I mean, and I also kind of mentioned this today too in our class. There's no runaway gap here to the downside like we got in February. In February we hit this big runaway gap to the downside, and maybe we'll see if we end up getting it on Monday, because we didn't get one until then. But we got that big runaway gap, and then it was down from there. But if you take a look at instead, let's see if I can go out far enough over here. I might have to just go to a daily chart, but go to a 2-year chart. This same time frame over here where I was talking about, where we hit the 23 and we went to the 38, we didn't get a runaway gap here either. So that's what we're not getting one now, which tells me there's a very good chance again that this is nothing more than that exhale, and that once we do finish exhaling, we'll have a very good chance, especially with how weak the dollar is, you'll see here in a second, a very good chance that we continue to trend higher for the rest of the year. The VIX also too is still right in the sweet spot of its bullish zone, so we're hardly bearish at all there. And if and when we do get a bounce, and we will, right, we'll get a bounce up in volatility, more than likely corresponding with an intermediate pullback, because it's coming from a lower level instead of coming from up here where there's a good chance we could bounce up and really be bearish. We're coming from a much lower level, which means, well, we might pop up to 32, maybe 35, maybe at the worst up into the low 40s, but more than likely into the high 30s, and then that's it, right? It kind of again shows that we're not going to fall off a cliff. We're not going into double dip mode. We're not going to retest those lows from March. We're not, and there will be a lot of that chatter, right? Because anytime the market goes down for a few days, then the world's going to end. So there'll be a lot of that chatter online, but the reality is it's just a pullback, and once we hit support, once we're done exhaling, then we're going to, and that's what I'm going to actually talk about in next week's technical analysis class on next Friday. We're going to talk about, okay, what kind of signs we're going to look for when we do that the exhale is over, and that we're able to get going again and start trending higher again, not just on a broad market basis, but on individual stocks too. That's our topic for next week. So more than likely, that's what's going to end up happening if and when we do get a volatility jump. And it makes it more likely that that will happen because of how low volatility finally got. It finally broke below 90. Not enough to like establish a good trend because, that ATR, the ATR here is still above 1%. So once you get below 1%, that's when you get the slow grinds that last, that go up slowly, that last a long time. That's when you get those. So we're not there yet, which means, again, similar to what we saw back here on this low point, once we got up here, we were actually below 1% on that rally, but we dropped down below, we got above the 1%, kind of similar to where we're at here. And then when we bounced back up, we got below the 1% mark. Bounce back up again below 1%, stay below the 2, which we are now, and we'll go. So kind of watch for, not very big moves. We most likely will not get, as big of a move to the downside as what we've seen here. We're more than likely going to get kind of like maybe 1%, at most maybe 2% drops. But we're not going to be getting 3 or even more. Like over here on June 11th, we had fallen 5%, and we had a huge gap to the downside. No gaps here, no huge gaps to the downside. And again, going back to that time frame where we've compared before, so back over coming off that 2019 Christmas Eve low point of 18. By the time we got that intermediate pullback over here, you can see we didn't get significant drops. A percent, maybe 2, but that's it, and that's what I expect. Even though we were crazy over here, we're not going to be crazy again. All right, so before we look at some other, like in terms of what's driving the market and our trade idea of the day, just to review our technical outlook, we're strongly bullish. The trend is the long-term trend is intact, but that doesn't mean that we won't get a little bit of an exhale, and it appears increasingly likely we'll get that exhale starting this week already, continuing into next week and beyond. There obviously are some big earnings announcements next week, so there's also a good chance that we can pop up next week, but that doesn't mean necessarily that the pullback is over. So if we do pop up next week, just watch out for divergent high points. They'll be cropping up like crazy, especially like on the RSI, on the stochastics and the MACD. So, which is still the process of an intermediate pull. It's slower, but it's still a process of a pullback when you get divergent highs. Because the oscillators are still moving down to lower highs and lower lows. It's just that price popped up more than it should have, and eventually that corrects, right? So that's a possibility. It's a lower probability for next week, but it's a possibility. More than likely, we are headed. We are in the midst of our exhale, which will be a lot worse than it. Which will appear a lot worse than it actually is. Right, it won't be that big of a deal, according to some of these other indicators I've shown you. So what do you think? Do you agree with that outlook? Do you disagree? Comment down below, especially if you disagree. What's driving your opinion that makes you either a lot more bearish than that, or that we're not going to get an exhale at all, that this is probably the extent of it that we're seeing here this week? Let me know what's driving that opinion, what indicator, what chart, what economic indicator that you're seeing that drives that. Share with us, our community, in the comment section. All right, now let's take a look at what's driving. And again, the big factor in current moves is this tremendous jump this week. In fact, if you look at it on the weekly chart, look at that rally that we've had in, let me give you some context, a rally that we've had in the euro. That's a big week here, to the point where, this is on the weekly chart, mind you, we almost got a cluster, like one of those really bullish clusters. Yes, it's an overbought cluster, and if you ask any old investors people, they would call that a bearish cluster, and they would expect things to go around. But the reality is, when you get these clusters, when the intermediate line's crossing into the reversal zone, you get a cluster here. It's a very bullish pattern. So, in this short term, we might get a little weakness here or there, but it just means that we've got a good chance that we can get this this market sentiment line going for a while. And the last time we had that was over here. We just turned bullish, dark green shading green line. We busted into this retracement zone of the drop of this bearish intermediate decline that we had. We busted into that retracement zone. We are now in the upper half of that retracement zone. So we're working our way up through. There's a blue line coming down from these highs. So we're close to crossing through there. And you can see, from 02 all the way up to 08, we had 6 years of where the dollar went from, 0.85, essentially, 0.86, all the way up to, almost 1.6. Well, it did get up to 1.6. So, and there were some bullish runs, and ever since then, the bullish moves have been the lower highs. This is the first time we're coming off of a higher, all these bullish moves came off of progressively lower lows, except for that one. This is a much higher low point. And so there's a good chance that and you can see how that one took a while to get to that trend line. We're already there. So there's a good chance that we reverse this trend line to the upside and really get moving here. And you can see from a linear regression, just to kind of give you an idea of how stocks performed from mid-April of 02 all the way up to July of 08. Remember, the stock market was bearish. It peaked right here. This is where the stock market peaked in October, actually right around here, October of 07. That's when the stock market peaked. The dollar continued to go down, which really pushed commodities up. Inflation, right, is lagging, so that continued to go up. But if you look at how stocks performed, and you won't be able to get, let me go to the asset. We won't be able to get a whole lot because none of these ETFs were in existence back then. But to kind of give you an idea here, from mid-April of 02 to July, beginning of July of 08. This is how these different asset classes performed. So especially international. So look at EFA. Got to eventually up to, in October, when we peaked in October of 07. The S&P was up 40% because we had a continued drop into 03 as that euro took off. But from that point, look at the equities performance, 110%. You don't have EEM here because it doesn't have the history, but IWM was killing. QQQ did very well as well. So very, very bullish during that run of the euro through that, and especially when you come off of these lows, off of the March of 03 lows. So if I were to go as this trend has established itself, March of 03, you can see the returns are great. And there's TLT, and it didn't really go down. It's just flat during that whole time. But you had a good run. International equities up 180% off those lows. QQQ, IWM, SPY, all really bullish by the time they got to those. Again, all on this weak U.S. dollar. So that is a factor, and again another factor too that you didn't have back then that we do have now is just how bullish bonds are. I mean, this is like long-term bullish here on long-term bonds. The weekly intermediate line is still kind of flirting with this market sentiment, but look how bullish we've been, and we started to drop a little bit, but we haven't started a pullback at all. In fact, we're closer to these highs than we are to any kind of pullback stage on bonds. So unlike that other period here, and we don't have a whole lot of that, so let me go back as far as we can on TLT. So this is where bonds, where the euro took off, right, and so did stocks all the way up to this October 8th low point. You can see bonds were not overbought back then. They were kind of subdued. Not the case now. So again, that unwinding will also be a very significant tailwind for risk appetite going forward into this next year and a half, next couple of years, as the euro really, and when I say the euro takes off, it's more the dollar really starts to drop. And you can see we've been, even over here in the mid-90s, this was not the euros, the Deutsche Mark back here, but you can see even back then, like, this is kind of the highs, and we were just there in 2014 before the dollar took off in middle 2014. So a run back into that area, back to this 162% level, that would be significantly bullish for risk appetite just in general. Very, very bullish, especially for these international equities that are so oversold relative to U.S. equities, and for that matter, for the Qs, as you saw on some of these other charts. They will do well. There's going to be periods where the Qs will continue to outperform versus IWM, and periods where IWM outperforms as well. But especially those international areas will really start coming back to the mean, returning to the mean, so to speak. If I look at the linear regression here for the euro US dollar, but look at it on a long term, I mean, look how bullish that is on the daily chart. So in this very short term, we might get the dollar is a crowded trade. Selling the dollar right now is a very crowded trade. Buying gold, very crowded trade. Don't be surprised if that crowded trade leads to a short term pullback. And remember, on intermediate pullbacks, that's usually bullish for the dollar. So that's probably what's going to, uncrowd that trade a little bit as we get some kind of intermediate pullback. But if I were to zoom this out to a longer time frame on the linear regression, look at it on a weekly chart, on this 10-year chart, you can see not nearly as overbought. We've got a long ways to go before we get into closer to these 1 standard deviations. And that doesn't necessarily mean that we can't change the trend, which would start to push these bands up a little bit higher here. All right, now let's take a look at how these sectors are doing. And let's just look at the week, just this week alone, to kind of get an idea of safety, like risk aversion or risk appetite. Let's go out to a 15-minute chart. So this is from the beginning of the week. You can see technology started strong, discretionary was staying bullish, energy had a really good run and stayed relatively bullish throughout. Discretionary held up, but not technology. And you can see communication services was kind of the first one to get really weak. It lagged, and then it really kind of went down first here. But look at technology. By the end of the week, it was down 1.5%. Communication services, which has a lot of these big mega cap tech names in them, like Facebook, Google, Netflix, down about 1% for the week. The market itself down 0.25%. The winners, energy, materials. Dollar was very down this week. Even though bonds were up, financials did well, and the consumer stocks. With the dollar getting weaker, consumer stocks do well. You can see XLY, XLP both outperforming, and then your safety trade, utilities are up there. Industrials kind of matching the market, but healthcare, communication services, technology, your leadership previously, and has been the leadership for for a while now. I mean, you go back to that March 3rd, 23rd low point. Let me get to it, like a couple hour chart here. There we go. So off of that low, probably the 24th. Let's go to the 24th here. So it includes, it's basically coming off of that low. So it includes the gap. There's the gap coming off of that March 23rd low point. You can see your leadership, right? Energy is doing really well. Materials is doing really well. But you can also see technology, discretionary. Then there's communication services, which has kind of been lagging a little bit. Industrials starting to pick up. Industrials and financials had a really good run during that, that period right there where the Russell really kicked butt, right? And there was this idea of we're going to rotate into these really crappy energy and industrials and financials, all these sectors that were just so beaten up. Lagging during the bullish rally initially and really dropping during the COVID decline. They really rallied pretty hard during this last leg, but you can see now financials struggling, industrials not nearly with the same outperformance, technology getting back its leadership with discretionary, and then healthcare kind of gaining and then lagging and still lagging here. So when you look at that, you say, okay, well, what that means here is this week right here, and let's go back to a 15-minute chart, is that our strength is coming down and some of that weakness is gaining, and especially the weak dollar moves. And shoot, the energy materials have been strong. We kind of expect that they will continue to be strong as long as the dollar continues to be weak. Again, now maybe there's going to be it's a crowded trade to sell the dollar right now, so there might be some little element where it kind of takes him a little bit to get going, and you can see energy's kind of been a struggler despite in the last few months here, but you can see the strength here in materials. You can see the strength in gaining in industrials and financials. They're starting to kind of roll over. In fact, when you look at the relative rotation chart for all these different sectors, you can see there's your leadership, discretionary, communication services, technology, moving down to the left. There's your safe haven trades moving up, potentially to the right, and then ahead of them, kind of on their own pace, is materials, as well as industrial, financials, and energy. They're moving up. So this is kind of another sign that we are not changing leadership, but just exhaling. Right, we're just exhaling, and I wouldn't expect these to go too far into the red over here. Maybe just a little bit before they turn back up. I wouldn't expect the safe haven areas to get too far over in the green. Maybe even most likely, it'll probably kind of stall right here and turn back down and get back down into the red. This depends on how long this intermediate pullback lasts. Which, when it does begin, it might not begin right now, but when it does begin, you only would expect it to go down for a few weeks. Before we do hit that 38% retracement, and then we start rotating back up again. All right, so for our trade idea of the day, I do want to take a look at a stock that's in that tech space, but with China has been kind of lagging behind. If we take a look at Baidu got below its 17-day moving average and stayed. Right, it got below the 30-day moving average. Instead of bouncing, it really dropped down today. Its MACD is going down, stochastics is close to being in the reversal zone. You can see some other oscillators that are showing some sign of weakness here. You take a look at, you can see also we're breaking through that low point there, but we're breaking below 50, we're breaking below negative 100, we're getting to lower levels that we've seen here on Baidu for a while. You take a look at its Bollinger Bands and point of control, we broke below 25%. We broke below the value area. We're really starting to push down. We have earnings coming up, and you can see the point of control down here acting as kind of a gravity pull to the downside. I mean, there will be some support in Fibonacci retracement zones, and we don't necessarily need this. The trade you'll see here in a second, we don't need it to go down too much. We just need it to stay down, and as you can see, even looking here. It got its this is the candle I showed you that the NASDAQ 100 is getting right now. It got that pattern last week, and you can see the bearish candle that we're getting now Again, if that leads into a few more weeks of candles heading in and through earnings to that expiration, then we have an opportunity to be to add some bearish deltas without being too bearish, adding some bearish deltas to our portfolio. So what we did is we came here to August expiration and we sold the 124 call and bought the 127 call. So we did a $3 wide because we're going, there's so many strikes here between 30 and 40 deltas. We were able to go out a little bit wider and still get some pretty good credit. We ended up getting, was that 92 cents out of this. So $460 is the reward we're trying to get. That means that's how much we're willing to lose. So for us to lose that right now, $460, that would be a move up to 131. So you can see basically that would nullify this breakdown and basically get back above this high point and really kind of reverse things back up to the upside. At that point, we would take a small loss on this. But for that to happen, you can see the odds of getting a good return on this, or any kind of return on this, is pretty relatively high. So we don't need it to go down. As long as it stays down below 124, then we make our money. And you can see from a Bollinger Band standpoint, 124 is back above this value area. So as long as we hold this node and stay in the value area, we're good. If it breaks back out of it and we continue to trend higher, then we'll take the small loss on the trade and move on to something else. If it goes down faster, harder and faster, and we can get the 50% of this maximum gain, say get down to 110 here really quickly, so we get $230 really quickly or more, then we'll take it, right? If we can get it, in the next week, we'll take it so that we can do another bear call spread and try to get a new maximum gain on the new trade instead of settling for the other half of this max gain on this trade. So again, that would make it move down essentially to 110, and you can see how easy that would be. So if we do get a good move, we can get a good return pretty quickly. If we don't, as long as we stay down here, then we make our return that we're shooting for. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link that goes to our Market Outlook forums at marketscholars.com. Open up any new thread with any questions or comments you have about what we talked about today, or reply to anybody else's threads. And let's keep this conversation going between videos here. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the videos. Join our Market Outlook Facebook group that we've created, as well as our community at our website at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all on Monday.